Barry, you were saying that you believe that investors had the market wrong, or the interpretation of what was going to happen back in June when we saw the market rally, and you also think that they have it wrong now. What does that mean, or what do you think is the right way to interpret the market, more importantly?
Right. Well, 3 months ago in June, the market concluded, based on a small number of weaker economic data points, that the Fed was going to raise rates to 3.5%. So 3.5% was going to be the terminal rate. And then they had built in that once we got to 3.5%, that they were going to be cutting rates almost immediately within a couple of months. And based on that market view, the NASDAQ went up 17, 18%. The S&P went up 12 or 13%. The 10-year Treasury yield went from 3.5 to 2.5. Now, here we are 3 months later, and the market view has changed dramatically. Now the terminal rate is not 3.5%, it's 4 to 4.25. And now the market is expecting the Fed to take it to 4 to 4.25 and leave it there for 12 to 18 months. And just like the view in June was wrong, I think this one's going to be wrong too. I think the Fed will take rates to 4 to 4.25. But I think there's a lot of evidence that the economy is slowing. And I think once it starts slowing, it becomes almost self-fulfilling, and it's going to slow very rapidly. The Fed will then have the conundrum where the economy is really slowing, but inflation is still sticky. And so we'll see whether they choose inflation or unemployment at that point to target. They're clearly laser focused on inflation right now, and they're not concerned with employment because the unemployment rate is 3.6%, and the labor force participation rate has actually risen in the last month for the first time in a year and a half, which is very encouraging for the Fed.
Right.
So we'll
Right.
see how this plays out, but I don't believe that the economy can really handle 4% interest rates, given how indebted it is, for as long as 12 to 18 months before the Fed's forced to cut.
Okay. So I want to bring in the BOC, the Bank of Canada, into the conversation as well, in terms of the aggressiveness that they've been employing as it relates to rate rises, or I think it might be aggressive for also an indebted country. What do you think? And in a hot housing market that we've seen for a decade.
Right. I think they're even more aggressive than the Fed, doing 100 basis point meeting. And I think the Canadian economy is even weaker, or the trends are even weaker in the US, because we have over-leveraged consumers and we have a much weaker housing market than in the US. So I would expect
you said that the trends are sorry, Barry, the trends are weaker in Canada, not the United States.
That's correct. And
Okay.
so we have weaker economic trends in Canada, and we have an even more aggressive central bank.
How does that play out?
Not well, generally, for the economy.
And so, Barry, how do you want to position yourself then? I mean, do you become even more narrow in what you want to own and invest in, and make sure that you've perhaps liquidated other areas of your portfolio?
Yeah, well, I think, if you look at fixed income, and fixed income has two components. It has duration and credit. And I think that people should be avoiding credit, because I think credit is the most expensive part of the investment. Credit is much more expensive than equities are here. The NASDAQ is down 20 plus so far this year, and high yield credit spreads are 100 basis points wider than they were. If you look by historical correlations, high yield credit spreads should be 250 or 300 basis points wider if the Nasdaq's
Okay.
down 20 to 25%.